Hey, my name's James Nicholson. Welcome to my YouTube channel. The Bank of England data is in and they've held interest rates. In this video, I'm going to break down the votes. How close was it? Were we closer to a cut than you may have expected? I've got that data here. We've also got some interesting insights into what's happened in America. It might not be good news for mortgage rates in the UK moving forward. So you want to know all about that as well. And if you're new around here and you haven't done it already, do subscribe to the channel over there and hit that bell notification. We've got new content every single day on this channel. We talk about house prices, interest rates, property investing, and much, much more. And let's get some views on this channel, on this video even, so more people know about this data by smashing like, tickling like, doing something to that like button. That really helps with the YouTube algorithm and that helps us get more views. So thanks to everyone that does that. Give it a Christmas smash. So, what's going on? Well, the Bank of England had their meeting today and the economists were right. I was right as well. I've been saying this for a week. Everyone else has been saying it for a week as well. It was highly likely that the Bank of England would hold the base rate, and that's exactly what they did. So the base rate is sticking at 4.75%. So we had two cuts this year. We had one in August and we had one last month. And that was it. At the beginning of the year, the talk was that we could have 4 or 5 cuts. And they really did slow down as inflation started to come back. Now, the frustrating thing is that a lot of the stuff that's causing people pain is these higher rates. I'll tell you why. It's because those higher rates are increasing people's mortgage payments, and your mortgage payment is generally more than you're going to be spending on food. So while grocery inflation is important, it also hits you very hard by having these higher rates. Landlords get hit very hard and they're on interest-only mortgages. So if their mortgage went from 2% to 4%, their payments double. Ultimately, that gets passed on as rental increases, and that rental increase is featured in the inflation data. So if you look at the things that are going crazy in inflation at the moment, which is why these rates are staying where they are, is all stuff out of our control. It's accommodation. So your mortgage payments and your rental payments are higher. It's also your energy costs, which you have no choice about. You can't really even move provider at the moment. They're all really expensive at the moment. It's your food costs that are going up, and that can't be decided either. And so keeping these rates higher, I don't think is the right thing to do. I think it should start to go down and give people some respite. So what was the vote on this? Because there are 9 members of the policy committee. So how close were they? Was this nearly a 50-50 split, or was it more than that? Well, the vote was 6-3. So 6 people voted to hold the rates, and 3 people decided that they would like to cut the rates. So it was quite a strong majority there, but it's good to see that some of the policymakers want to see cuts still. And we hope their voices get loud in the next meetings and people really listen to what they've got to say, because they have obviously discussions and they look at data. And so it'd be interesting to see if those 3 people can persuade those other 6 to give us a cut when we go back in February. There's no meeting in January. The next meeting is the 6th of February. So where are we expecting rates to go? Well, the Bank of England came out last week and said 4 rate cuts are likely in 2025. So that would take us from 4.75 down to 3.75, which is not really where we want to be. But it gets worse because the Federal Reserve did their rate cut, even though they're expecting inflation to rise significantly in America for quite a while. They're talking about until 2027 with their rate, with their higher inflation. They're expecting their inflation to go quite close back up to the 3% mark, but they did cut the rate. So the Federal Reserve has a rate at the moment of 4.25. So we're half a percentage point different. And normally we like to be fairly close to the Fed. So this does give us some room to have 2 cuts and still be fairly close to where they are. But what was interesting with the Federal Reserve meeting yesterday is they were quite clear without saying it, because they can't come out and be political, but it was the questions from the media. I watched the press conference afterwards, and the questions were a lot about tariffs. The tariffs are expected to really actually hurt the American citizens by increasing their costs significantly. And it makes sense, right? So if you buy some cheese from Canada, then you put a tariff of 25%, you buy it for $100. That means when it gets into America, it costs $125. Canada's not paid any tax. It's the American importers that are paying that tax. That's 25% extra in your costs that, of course, you're going to have to pass on to the consumer. And so if this happens, that is what they're expecting, is inflation to come back in America. Now, will that impact our inflation? No one knows for sure. There aren't talks at the moment of putting tariffs onto the UK, but that could change quite quickly, couldn't it? If a trade war starts, it's probably not going to be great news for anybody. And we don't like to decouple from the Fed too much, because our currencies are so intertwined with each other. So the Bank of England are looking, as I said, at cutting 4 more rates in 2025. What could accelerate that is the economy. So we have our own different problems in this country. The problems that we're facing at the moment right now is the unemployment levels. So the unemployment levels are expected to increase. There are big retailers now saying that because of the budget, they're going to be cutting staff. There's big retailers as well that I saw in the news today, that Klarna, you guys probably seen Klarna. It's where if you buy it on a store, you can pay in installments. A lot of companies have that now. Klarna said they don't need to hire any new staff. All of the new employees that they would have had will now be replaced by artificial intelligence. So artificial intelligence also could bring unemployment into the UK. Now, if we suddenly get mass unemployment, or it starts to tick up quite quickly and we go into a recession, which is likely to happen if people are losing their jobs, then the 4 rate cuts could get deeper. Right now, they're saying 0.25% for each cut, or they could get faster. So it could be that we go to 0.5%, or it could be that we get 8 rate cuts next year. It really is dependent on the economy. If the economy stays fairly stable, as it kind of really has done this year, then we're going to be stuck with 4 rate cuts. And that gives you your expectations on what you can do if you're planning to buy a property or to remortgage a house or something like that. So Bank of England held. Not great. Not a Christmas present for any of us, really. Those that do benefit, though, are savers. So savers obviously aren't going to have their rates cut. What do you think about it? Do you think they should be cutting quicker, or do you think they should be keeping it as they are? Do comment on the video and let me know. Do smash like, do share this video, and check out all the other content on my channel, including this video right here.